A bond is a way for an investor to lend money to an issuer, such as a government, a company, or a public body. In return, the issuer promises to pay interest and return the original amount at a set date. The main types of bonds differ by who borrows the money, how the interest works, how long the bond lasts, how risky repayment looks, and how the investor gets access. Government bonds. Government bonds are issued by national governments when they need to borrow money. The basic deal is simple. The investor lends money to the government promises interest, and at maturity, it is supposed to return the principal. For a beginner, the important point is the borrower. Here, the borrower is the national government. It is not a company, and it is not a fund. That is why government bonds often sit at the foundation of the bond market. They are used to finance public spending, manage government debt, and give investors a reference point for what lower risk borrowing can look like. The local name changes from country to country. In the United States, people often hear treasuries. In the United Kingdom, they may hear gilts. Those are local names for government bonds, not global names for all government bonds. Corporate bonds. Corporate bonds are issued by companies. Here, the borrower is a business. A company may issue bonds to fund expansion, refinance old debt, buy equipment, or raise money for its operations. The investor does not become an owner of the company. The investor becomes a lender. That difference matters. A shareholder owns a piece of the business. A bondholder expects interest and repayment of principal under the bond's terms. Corporate bonds often pay more than the safest government bonds because companies can carry more credit risk. A strong company may borrow at a lower rate. A weaker company may need to offer a higher yield to attract investors. For a beginner, corporate bonds show one of the central trade-offs in bonds. More income can come with more risk that the issuer may not pay as promised. Local government bonds. Local government bonds are issued by public bodies below the national level. That can mean cities, states, provinces, counties, or similar local authorities. The money may be used for roads, schools, transport systems, water projects, or other public needs. In the United States, a common name for this category is municipal bonds, often shortened to munis. But muni is not a global term, and the tax rules around these bonds are especially local. For a global English-speaking audience, the cleaner term is local government bonds. The key idea is still the borrower. A national government bond is issued by the central government. A local government bond is issued by a smaller public body. This helps avoid a common mistake. Public sector bonds do not all have the same risk, the same tax treatment, or the same market structure. The practical question is, which public body owes the money, and what supports its ability to repay? Fixed-rate bonds. Fixed-rate bonds pay interest at a rate that is set in advance. If a bond has a fixed coupon, the regular interest payment is based on that fixed rate, even when market interest rates later move up or down. This is the version of a bond many beginners picture first. You lend money, the issuer agrees to a fixed interest rate, and payments arrive on a schedule until maturity, as long as the issuer pays as promised. Fixed rate does not mean the bond's market price is fixed. If the investor sells before maturity, the price can still move. A bond with an older, lower fixed rate may look less attractive when new bonds offer higher rates. A bond with an older, higher fixed rate may look more attractive when new bonds offer lower rates. So fixed rate means the interest rule is stable. It does not mean the investment value can never move. Floating rate bonds. Floating rate bonds have interest payments that can reset over time. Instead of locking the interest rate for the whole life of the bond uses a rule that adjusts the payment. The rule is often based on a reference rate plus an extra amount called a spread. A beginner does not need to memorize benchmark names at this stage. The main idea is that the payment can change by rule rather than staying fixed. In market language, these are often called floating rate notes. You may also see the abbreviation FRN in broker screens or official documents. Floating rate bonds can be useful to understand when interest rates are moving, because their payments may adjust in a way fixed rate bonds do not. they still carry bond risks. The issuer still has to repay. The bond can still have credit risk. The practical difference is the payment mechanism. Fixed-rate bonds keep the interest rate set, while floating-rate bonds allow it to reset. Zero-coupon bonds. Zero-coupon bonds do not pay regular interest during the life of the bond. That can sound strange at first, because many people think bond income always means regular cash payments. With a zero-coupon bond, the return is built into the price difference. The investor buys the bond below its face value. If the issuer pays as promised, the investor receives the face value at maturity. For example, a bond may be bought at a discount today and redeemed later for a higher face value. The investor's gain comes from that gap, not from regular coupon payments along the way. That is why the name zero coupon is useful. The bond has no regular coupon payments. For beginners, the key lesson is clear. A bond can produce a return without sending cash every 6 months or every year. It works more like a delayed payment. Money goes in now, and the expected payoff comes at maturity. Inflation-linked bonds. Inflation-linked bonds are designed so that part of the bond's value or payment calculation adjusts with inflation. Their goal is to help protect purchasing power. If prices rise over time, ordinary fixed payments may buy less in the future. Inflation-linked bonds try to address that problem by connecting the bond to an inflation measure. The exact structure depends on the country. In the United States, investors may hear about TIPS, which stands for Treasury Inflation Protected Securities. In the United Kingdom, people may hear about index-linked gilts. Those are local examples. The global beginner term is inflation-linked bonds. The important mechanism is what changes. The principal, the interest calculation, or the final repayment can be adjusted according to inflation rules. These bonds can still move in price before maturity, and they still depend on the issuer. They are not a guarantee of profit. Their main role is to show that some bonds are built around purchasing power, not only around a fixed nominal payment. Short-term and long-term bonds. Short-term and long-term bonds are grouped by time to maturity. Maturity is the date when the issuer is supposed to repay the principal. A short-term bond reaches that date sooner. A long-term bond leaves more time between today and repayment. This affects how the bond behaves before maturity. When interest rates change, longer-term bonds usually have more room for price movement. Investors are comparing many years of future payments with the new market environment. Short-term bonds are usually closer to repayment, so their prices often react less strongly to rate changes. This is about time. A government bond can be short-term or long-term. A corporate bond can also be short-term or long-term. For a beginner, this prevents a major misunderstanding. Bonds are not all equally stable just because they are called bonds. The length of time until repayment can change the risk of price movement before maturity. Credit quality. Credit quality describes how likely the issuer looks to repay as promised. This is a label about repayment risk. It is not a separate mechanical type of bond. Two common labels are investment grade and high yield. Investment grade usually means the issuer is considered stronger by credit rating standards. High yield means the bond offers a higher yield because the issuer looks riskier. Some people call high yield bonds junk bonds, but that term can sound more dramatic than helpful for a beginner. The useful idea is simple. Higher yield often appears because investors demand more compensation for taking more credit risk. A high-yield corporate bond is still a corporate bond. It may also be fixed rate, floating rate, short-term, or long-term. Credit quality sits on top of those other categories. This matters because many people see fund names like investment-grade bond fund or high-yield bond ETF and think they are only choosing income levels. They are also choosing a level of repayment risk. Bond funds and bond ETFs. Bond funds and bond ETFs are ways to access bonds through a pooled investment. Instead of buying one bond directly, the investor buys shares of a fund that holds many bonds. This is an access format. It is not a new type of bond by itself. The fund may hold government bonds, corporate bonds, short-term bonds, high-yield bonds, inflation-linked bonds, or a mix of several categories. The practical difference is important. If you own one individual bond and hold it to maturity, your result is tied to that bond's payments and repayment, assuming the issuer does not default. If you own a bond fund or bond ETF, you own shares in a portfolio that keeps buying, selling, and holding many bonds. The fund's price can move daily. It may not have one simple maturity date for the investor. That is why bond funds can be convenient and diversified, but they should not be confused with holding one bond until it pays back principal. For many beginners, this is the format they see first in retirement accounts, broker apps, and model portfolios.